Political tensions are taking the lead on financial markets at the moment, and we are seeing a flight to quality, meaning a significant decrease in long-term interest rates. Three questions. First of all, the tensions between China and the US concerning trade. After the G20 meeting between the two presidents, we were expecting a truce. But the markets are not reacting nicely because probably negotiations will be difficult. We have several difficult issues: intellectual property rights, opening of the services sectors in China. So negotiations will be long and difficult, and the markets are not convinced. Secondly, we have the Brexit discussions at the British Parliament. We have a deal between the UK government and the European Commission, but the Parliament has to approve it, and we are absolutely not sure today that the Parliament will vote for a soft Brexit. If the Parliament refuses the deal, three possibilities: new general elections, a new referendum on the Brexit question, or a hard Brexit. So the British situation continues to be extremely difficult to monitor. So thirdly, we have the fiscal policy debate in Italy, where the situation continues to be difficult, but a compromise could be underway, with the Italian government probably going below 2% deficit, which should be in line with the European Commission target. However, it has to be approved, and we don't know yet if this situation will continue to improve. The markets are believing that it will, as the spreads shrunk to 280 basis points. So one of the difficult questions for 2019 will be the impact of those political tensions on the real economy. What will be the impact in terms of growth? Are we going to get a recession or not? We think that we will get a resynchronization of global growth, but with a lower level of economic growth compared to this year. It means that the US economy will slow down substantially from a high level in 2018. It will slow down because of the tightening in monetary policy. The Fed started to hike 2 years ago, so cyclical sectors linked to interest rates will suffer. And secondly, because the fiscal stimulus had an impact in 2018, but this positive impact will diminish in the future. Global economy will continue to get significant growth, but slower growth. It will be supported by several items. First of all, the domestic demand will be supported by the job creation process. Still a lot of new jobs in the US economy, but in mature economies in general. Secondly, inflation continues to be low, so interest rates are low also, and there is no reasons to get a significant tightening of monetary policy on a global basis. Thirdly, investments are on the rise and will continue to rise because, in fact, we have no excess at the moment in terms of investment. Overall, we strongly believe that we will get a slowdown in economic growth on a global basis with synchronization, but no recession at all in 2019. So financial markets are in a period of transition, which should continue for some time with a high level of volatility. The consolidation is underway because of political tensions. Those political tensions will not disappear just in one day, so the consolidation will probably last. However, the trend of a bull market will come back because fundamentals are still positive. This is our belief. And we think that we will get good news on the earnings front when corporations will start to publish earnings again. We did not change our allocation in terms of geography, so we stick to the positive view concerning the Eurozone markets, the Japanese and the emerging markets. We have made one change in terms of commodities, moving to a positive recommendation on oil. The oil price came under pressure too much, in our opinion, in the last 2 months. And now we think that the markets will start to rebalance with the end of the winter. And the oil price should come back toward the expected range, $65–75. Thank you for your attention and enjoy the Christmas festivities.